So Jefferies has come out with a report on Indian IT and they're now cautious and more selective. Now, according to them, AI risk is now outweighing near-term earnings comfort. And yes, Indian IT is down 14 to 16% year to date, but Jefferies still sees more downside than upside here. Now, talking about the earnings outlook of Jefferies, they've cut EPS estimates by 1 to 4% and only 6% of revenue CAGR is expected for FY26 to 28. Now, Jefferies estimates are still 3 to 14% below consensus. Therefore, Indian IT is still at the risk of further downgrades going ahead. And furthermore, stocks are likely to move on long-term AI impact going ahead rather than quarterly earnings beats. Now, talking about AI impact, AI will shift revenue mix from managed services towards consulting as well as implementation. This is significant because managed services contribute 22 to 45% of revenues for most IT companies, and therefore revenue might see some deflation here. And talking about valuations now, IT earnings growth are still 50% lower than Nifty, yet the IT companies trade at a premium, a big concern there. And furthermore, Nifty IT is also 32% PE premium to Accenture, and therefore keeping these things in mind, Jefferies has cut price targets by up to 33%. Now, here are some of the rating changes of Indian IT companies. These companies have been downgraded from buy to hold. They're Infosys, HCL Tech and Mphasis. Now, whereas TCS, LTIMindtree and Hexaware have been downgraded from hold to underperform, whereas Jefferies still remains buy on these companies, Coforge, Sagility as well as IKS. So overall, in the bottom line, if we look at it, Jefferies is preferring mid-sized IT companies to large caps as they have more fast AI pivot potential, and Coforge, Sagility as well as IKS are expected to deliver 19 to 25% EPS CAGR going ahead. So the bottom line here is to be selective, be more cautious and lean towards high growth mid caps rather than large caps.